to talk a little bit about, I think the effect of all of this product centricity, and if we think about this going back to in let's say in the U.S. market, let me just take a minute and cover a couple things, because the product centric phase of development in the U.S. started in the 70s when they deregulated the banking system, and so up until then you had this, and actually you may have heard this, the 363 rule. Did you ever hear about this? No. So old retired U.S. bankers will laugh and joke about the 363 rule during the days of regulated banking, which was you take in deposits at 3%, you lend out loans at 6%, and you're on the golf course by 3 p.m. But that, like after that, all of a sudden banks could sell in any state, and they didn't have these interest rate caps anymore, and it created this 20-year push of development. And they ended up launching a lot of products that were irresponsible, in my opinion. So irresponsible in the sense of, don't focus on your debt. Just if you can afford the payment, take the loan, and get what you want today, and so on. And a lot of people are suffering from that now, because now if you look at those people are hitting retirement age now. And out of 44 million people that will hit retirement age in the US over the next 10 years, only 60% of them have less than $10,000 in savings. So what does that do?
The question is, who's going to look after them?
Exactly. Well, they won't be able to leave the workforce, which means there's less room in the workforce for younger people. And then you have an outdated, let's say, skill set, or people that are not as healthy for the workforce as well, and they're going to lose their elder years when they should be enjoying life. And so, and if you think about that, this concept of financial literacy and who should be pushing it, after the financial crisis in 2008, the government regulated banks and said, you have to provide financial education. Well, where do you find it? You find it buried pages deep into a website, in some little, you have to look for it, and you don't find it. And banks really don't want you to know about this stuff. At one point I was thinking about writing a book called What Your Bank Doesn't Want You to Know. but I still believe that if we push these concepts, that banks should and will become more socially responsible.
I think though the issue is, in terms of financial literacy, that it's the exception around the globe where managing financial activity is in the curriculum. So where during the school years, you tend to learn about the world of money from brothers, sisters, uncles or aunts, friends, relatives, etc. So you learn from lots of different people, good and bad habits, rather than learning from the sort of item within the curriculum itself. And I think that on one hand, therefore, governments should be doing more to help people, but there's a role for the banks to play there in terms of helping people understand the world of money. I don't mean going into a school and getting a load of savings products so that you can access the parents to get their money as well, but doing it so you are part of that education. And I think education, education is really the basis for so many of the challenges the world has today. Where there are problems, it is often because of a lack of education. The more education improves, generally the world is a better place for those that are more educated, either in the jobs you get or the understanding of the challenges you face. And I think in the world of money, the banks have an opportunity to do something positive to influence their future customers. And if they are successful in that regard, then they're going to be able to get a better performing organization. It's interesting because I think COVID, will create a world which will start to see banks almost into two sectors. There'll be good banks and bad banks. The bad banks will make money the same as the good banks, but it'll be how they're perceived in the future. Yeah. That during the crisis, you helped me in a way that surprised me. It isn't that because the government said there's an interest-free period, or you don't have to pay your loan for 3 months or whatever, but because you were positively supporting me, I'll remember that. So I think the banks are moving into those two groups, and you want to be in the good group bank. You can make money. You can make money which is good profits and bad profits. Good profits, everybody understands what the rules are. If I do this, I get charged. The bad profits are when I do something and you charge me, but I never knew it was part of the rules in the game anyway. And too many banks make money through bad profit rather than good profit. There's got to be something in it for both parties. If there isn't, I'll go somewhere else.
Mutually beneficial relationships. That's
absolutely right. If that doesn't exist, there is plenty of other choices now. You know, in the old days, it was out of the frying pan into the fire. If I left one bank and went to another, I'm receiving the same service. Now it's different. Doesn't matter whether it's the fintechs, whether it's the neobanks, whether it's the Alibabas or whatever. Those organizations are bringing a different perspective to the world of money. Not about pushing product, but about making my life easier, making me more able to achieve the things I want for myself and my family.